Hi everyone, so let's now have a look at economic growth, the economic cycle and the output gap. Okay, there's a very useful model that we can use to actually understand this process of economic growth that takes place, and that is the economic cycle, or also known as the business cycle. Here we've got real GDP on our y-axis, meanwhile we've got time on our x-axis here. Now we can see that the economy is anticipated to actually go through these peaks and troughs, or these booms and these busts, or these periods of growth and periods of recession. So this is anticipated as what will happen for most economies. Now it's also likely that a trend rate of growth can be identified for an economy when all of its resources are being successfully employed to ensure that a nice level, a good level of economic growth is being attained. Now, we've got to remember that when it comes to economic growth, really, output for an economy is a function of the resources that the economy has, the land, labour, capital, together with the way in which they actually utilise these resources, the technical progress and the efficiency that helps to generate much better returns for an economy. Okay, so therefore, if we have a below trend rate, what we can see is that we're likely to see underutilised resources taking place, and therefore there would be a negative output gap, and that really is just suggesting that the actual level of growth in the economy is below the potential level for the economy. Meanwhile, we can also see that there can be a positive output gap. Where we've got a positive output gap here during this period of sustained growth or boom, then we can see that these resources are being very effectively employed, but there might be other things taking place, such as increased borrowing, that may be generating far greater output as a result of this big boom phase. Okay, let's talk about each of these periods just briefly here. So we've got our trend rate here identified, and the trend rate of GDP growth estimates the gains in the productive potential of the economy. Okay, and that's highlighted, of course, by our green line. Now, during this period of sustained growth or boom, then what we are likely to actually see during such a period is increasing consumption, increasing investment on behalf of businesses, as not only do consumers feel more confident, businesses really react to that consumer confidence, and they enjoy gains in their own business confidence. So that as a result of that, there may well be more capital investment taking place to generate more capital goods and expansion to increase the level of outputs. In addition to this, it's more than likely asset prices will be rising. So company profits will be on the increase in all likelihood, particularly for those companies that have normal or luxury goods, so goods with high positive income elasticity of demand. And as a result of that, there can also be a wealth effect, which helps generate a feel-good factor for the economy. So share prices, and in addition to that, other asset prices such as house prices are rising, then consumers may feel, households more generally may feel more affluent, and therefore again that reinforces that confidence. Now, as a consequence of this, though, there's going to be a pickup in demand pull inflation in all likelihood, together with increased cost push pressures as employees start demanding higher wages to compensate them for the increased level of inflation. Okay, now on the flip side, we can also see a recessionary period, which is going to highlight a negative output gap. Now, such a period here is likely to reflect one where workers are being laid off by businesses, and businesses then start to run down the existing stocks or destock from their current levels of stock to much lower levels of stock. And so that means that they can just run through that process and lay off workers. Of course, as a direct result of that, unemployment will increase, and that will mean that unemployment benefits paid by the government will actually increase as well. Further to that, the tax revenues taken by the government will diminish as more people are made unemployed and can no longer be taxed. Further to that, it's likely that companies' profits won't be as high, and therefore corporation tax will be lower. So those fiscal stabilisers help loosen the degree of fiscal policy. They increase transfer payments in the form of unemployment benefits, and the level of income and corporation tax will be reduced. The exact opposite as to what would happen during a boom period. In addition to this, it's likely that inflation will be very, very low. Okay, so there's a number of key elements that you will need to understand as we go deeper into this course. For instance, how will the authorities respond to such periods as a positive output gap or even a negative output gap? So the authorities being the government and the Bank of England as the Monetary Policy Committee. So what will they try to actually do to ensure better utilisation of resources and that this trend rate is sustained? Ideally, this is where you want the economy to be. So this is almost like the desired state of the economy, this trend line, but unfortunately it doesn't just go nice and smoothly like that, okay? Right, now we can also represent economic growth via a PPF. And so here I've just drawn two PPFs, and just coming back to this, that output or GDP is a function of land, labour, capital, technical progress and efficiency. Then you can see if the economy develops a greater ability to actually use its factors of production more intensively to generate greater levels of output, then it means that the PPF curve can shift out from PPF 1 to PPF 2, and we can move from, say, point A to point B, where we would have a higher level of capital goods and consumer goods being produced by the economy. Okay, of course, throughout the course you'll get to know this really well and understand the policy responses in detail to this, but this is a nice introductory approach to the fluctuations that we see in the economic cycle. Okay guys, thanks a lot.